Hey everyone, so today's topic is price action trading strategies, meaning whenever there's an extreme price action or tape action in the markets, what kind of strategies should we deploy as option sellers? As option sellers, when volatility jumps up and hikes up in the market, we get a lot of opportunities, meaning a day like today where S&P 500 futures and the index are down almost 50 points. VIX is up, it's taking a bid today, and therefore, it is something that we can take advantage of, by selling into the strength of the market. And today I'm going to show you what kind of strategies I deploy in these kind of price actions. I always, as a contrarian trader, look for extreme price movements, meaning either whenever the market is going down, that's a good opportunity to sell put spreads or puts because it gets you good premium on the put side, meaning in the strength of the market. When the market is going up, selling calls and call spreads gives you good premium on the call side. It's always important to sell into the strength of the market, meaning whenever the market is going up, we sell the call side. Whenever the market is going down, the put premium is juicier, and therefore we sell. Volatility has ticked up, and therefore we sell put spreads and put options. So here we go. Let's take a look at the platform and see what's going on. Okay, so this is my simulated trading account. So just follow what I'm saying here, trying to figure out in your head whether this makes any sense for your account, for your position sizing. Look at it in a totality of your portfolio. So extreme price action. Well, I wouldn't say extreme, but some price action in S&P 500 because usually this thing just goes up. And I don't like selling calls in S&P 500 or any other major indices because here's the problem. There's a big positive drift into the market. I would say 70 to 80% of the money that flows into the market is on the long side, meaning people try to buy equities, buy stock, buy ETFs, even when the markets are at the high. So I don't sell call spreads or calls in major indices, but I do sell a lot of puts and put spreads in these indices and in their futures options. Now, the reason for that is there's always a put skew in S&P 500 and other major indices because people try to buy protection by buying puts in S&P 500 more than they buy calls. And therefore, there's always a bid. There's always a high bid, on the put side. So let's just take a look at what kind of price action we are getting today and then what kind of strategy should we deploy. Now, in my real trading account, I have actually traded a put spread in the ES market, but that's also because of my adjustment that I've been carrying from a trade that has gone wrong or gone bad since the tariffs were announced early April. So I've been defending that trade. So today I just saw an opportunity to sell another put spread. It took me, it costed me a little bit of buying power, but it's again taking advantage of this volatility spike. So let's go through the list here. What have I got? Let's scan it from the top. Like the currency market is not really that juicy right now. Euro USD is trading at 1.13. This looks like a good trade. Where will I sell it? So let's take a look at the chart. I know this thing has dropped a little bit in the recent past. So does it look really attractive? Not really. The high was 1.16 and the low was about here, so 1.02. So the markets are really at the top right now. I mean, if anything, I would sell a call spread here, but I don't want to touch the call side. So I'll leave the currencies out. I mean, the crude oil market looks attractive to me. It's at the bottom, and there have been talks about the OPEC countries pumping more oil into the market and dropping down the price. And this is mostly to punish the over producers in the OPEC system. I don't know exactly what's going on, but this is what my take is, that the price may drop a little bit more, and when it does, then we will look into selling some put spreads here. Now at the low is at 55, so if it drops below maybe let's say 60, then the put spread comes into the equation. Now let's just go gold. Again, I don't ever sell calls in gold. I've been hurt before because gold has such a positive drift to it. Look at the hockey stick style chart here. It starts from the bottom left here and then all the way up to the right here. So it's like trading at 33.50 because as soon as something panicky happens in the market, the first thing people do is buy gold, and that's why it has a positive drift and it has people have a bid on it. They just keep bidding higher and higher. So us selling calls in this market is always prone to getting breached, prone to getting touched, prone to getting in the money on the call side. So I don't sell calls here. Do I sell puts? Not really. It's a difficult market to trade for me as a contrarian because yes, when it's trading sideways, maybe I will add one or two iron condos here and there, but in order for me to take a position or start a position, I started with a directional view. So either a put side or a call side, and then to defend it, I turn it into an iron condo. But this market doesn't look really attractive to me. If you look at the IV number is not pulling up here, but IV is not really that high. It is high. I wouldn't say it's on the low side. It is on the high side, but it's not so high that, take a position. Anyway, let's get to the chase here. I would take a position in ES, even the S&P 500 futures. It's dropped. It's coming back to its 32-day moving average. And if it goes below it, then obviously that's a bearish sign for me. I do look at this indicator. I don't know how accurate it is, but if you look at how this indicator works, it's if it gives you a bearish view, it does go down. The market goes down. So I'm researching more on this indicator and see how accurate this is. What's the percentage of it giving us the right signal? But for now, the market is down, so I'm gonna wait until see what happens, because Monday is off, right? Monday is the markets are off for Labor Day, and Monday the markets are off, so we don't know what's going to happen over the weekend. There might be more volatility, so we want to just take it very, very slowly, lightly. But today has provided us an opportunity to trade something, so I'm going to look at the price extreme in S&P 500 futures, which is what I'm doing right now, and then let's set up a trade. So again, the trade is the market is down, so the trade is on the long side, meaning we will go and sell a put spread. Now, how to select the strike prices and the expiration cycle, that is the most important thing here, because you don't want to initiate a trade which may hurt you in a few days. You want to go into a trade by scanning everything in the market and then taking a position. So when I say that, I would take a position, even though I don't normally go beyond 45 to 50 days, but because there's an opportunity in the market, I would go into the 56-day cycle, which has the highest open interest and volume. Volume is on the low side here, but open interest is really high. So I'm going to go into this cycle and then select my delta. Now my delta has always been between 17 and 20, this range, 17 and 20. I barely go beyond 20, and I barely go beyond 17 on the low side. So beyond 20 on the upside, and I don't go beyond 17 on the low side. So just keep that in mind. This is how I trade. I have found success trading this way. So maybe you can try a few things in your paper trading account. That's one of the takeaways today, that go there and try and practice this thing and then see how it goes. So again, the way I will set up a put spread in here is right click, sell, and then go vertical. Okay, now when you go vertical, I do need to change this to go back to one contract, because that's how I normally start, with one contract. Now this thing is giving us 3.4. That's the price. 3.5. When it does 3.5, that means it's giving us a total credit of 175. You have to just divide that number by 2, and that's how many actual dollars you will get by trading this. Okay, so if you're gonna go back and right click and analyze this trade. So let's do a right click, analyze. Let's see where it goes. Again, I'm trying to find a higher probability trade, meaning it has to have a more than 80% chance of making money for us, and it looks like this thing has. So I'm going to set slices to break even to 719, because it's a July expiration now. Always make sure your date on the top here is also lining up with your date here on the bottom. And then let's look at the max profits and everything. So look, this is the 85% pop I was talking about. The expected move is covered completely. So the gray zone is actually the expected move of this underlying during this time. So from now till the expiration, based on volatility and all the other factors, the underlying is expected to move within this range, which is the gray area here, the gray zone. And looks like our put spread is going to cover that gray zone. Okay, so that's a good thing. Our max loss is $1,075, $1,075, but we don't ever let it go to max loss. We have management techniques that we deploy if it goes against us. So what else do I need to check? I need to check my Greeks. Now my Greeks are delta. My main ones are delta. Gamma I don't really look at, because gamma only comes into the equation when it's the last 20 days of expiration cycle. So we want to make sure we don't want to get stuck or stranded in the last 15 to 20 days, because that's when gamma starts kicking in. And when gamma starts kicking in, it hurts your delta. So meaning it pushes the delta, it nukes the delta, and then delta moves all over the place. So we don't want to get strangled, within doing gamma scalping in the last 20 days. We want to do that before that. So when there is more than 25 to 30 days left, that's when we think about adjustments if needed. If the trade goes well, we will just let it off, take profits off at 40 to 50% max, and then we redeploy capital. That's the whole idea. Now, volatility is up today. Let's look at where the VIX chart is. VIX futures are up 4.65%. So that's a good, nice volatility premium that we're getting here. And what else? So we have negative vega, obviously negative short vol. So when you sell an option, you are always shorting the volatility piece, and you are long theta, meaning you are collecting money, within the time decay. So I've checked everything. Everything looks good. Let's see how much money do I need to put down to initiate this trade. Now the platform is asking me to put down $362. Is totally fine, but look at the ROI. If you collect about $100 from here and you initiated this trade with like $360, that's a good ROI percentage, meaning it's a good 25% over that return in this trade. Now annualize that number. How many times can you do this in a year? And that's when you get to your annualized return number. So that's what I want to show you. Max loss is 1075. That's totally fine. And then let's try and put this trade in. So taking advantage of price action today, this is what it's all about. This is how I normally trade. Whenever there's a price extreme or price move, I take the contrarian side. Now there was another thing that I was noticing, the 30-year bond market. It's got a good price action on it. Look, it's down at the bottom. If I were to take another trade today, I would do this. Again, let's set up a trade here as well. Okay, so looks like our ES trade has been, it's working. So it's working at 350. But it doesn't really matter. I can just show you like how it can be filled at 325. This is just for illustrative purposes, so I don't really care about the pricing right now. But in my real account, I would have left it at 350. I would not have gotten filled anything less than 350. So I would have just left the trade there, and then I would have tried to get at least more, 350 or more. Now the next one, it's not even filling at 325. That's weird. Okay, let's leave it at that. Okay, another price action trade today is the 30-year bond market. Now look at the chart here. It's right at the bottom. I'm in the wrong chart. I need to be in this 30-year bond market. Remember, each tick is $15.625. Really weird. You don't need to worry about that. I'm going to make another video of like explaining the whole futures market first, of how this 30-year bond works. But each tick in this bond market will affect your P&L about $15.625. So you just need to know that. Okay, so market is at the bottom. Great opportunity to sell something here, meaning on the put side. So if I were to take a trade, now here's the dilemma, right? Now we either have 28 days or 63. Now 63 is too far out, so I would have taken a trade in 28-day market, which I don't normally do. So just be wary of that. I don't normally sell into less than 40 to 45 days or 35 at least. But if I were to take an opportunity here for a quick win, I would have sold a 22 delta. Now I could have sold 16, but again 16 would not have given us enough credit for us to make this trade worth our time and effort and everything. We need to collect a little bit more than $150. So let's see how much are we collecting. It's trading for 12 ticks. Each tick is 15.625. So multiply that and you get 187.50 total, and you pay 450. But again, this is not a real charge. The actual charge to get into a trade, a two-legged trade like this on your real platform, or at least on my real platform, is about $7.30 because it's missing the exchange fee here plus 3 point something dollars. Okay, so just remember that $15 out of each trade is you're going in and getting out without any adjustments. If you do make adjustments, then that's another $7.50 each time you make an adjustment. So just remember that. Okay, this thing is asking you to put down $313. That's totally fine. Again, a good ROI if we don't have to adjust or touch the trade at all. So let's just send this one in too at 12 ticks. If it doesn't fill up, and they're both working. Anyway, the point of this video is not to like make sure that we get filled. It was about the whole process and the setup and how I would have traded the market today. I did trade this market in my real account, in my ES account, which I will make a video of later and just show you how I'm defending the trades. And then that's it. This is the price action trading strategy. Thank you very much for watching, and I'll see you next time. Don't forget to subscribe to my channel if you like it. I just want to show you one more thing that's running recently. Here I want to show you what's coming up. There's a webinar that we are doing in 6 days. It happens next Thursday. I think I might have to move this date to Friday, but I'm going to double check. But yeah, it's happening next week, so make sure you sign up for this. I will put the link for this in the chat. In the description notes and the show notes. And there is a full-fledged 5-day trading challenge that we run within our community. I would like to invite you to take a look at it, see if it works for you. If you're new to trading, this may help you get the ground running, and start putting some trades on. What we cover in this 5-day challenge is there are no checklists or anything. I don't give you a big piece of material to go and read and learn. This is me showing you, holding your hand and showing you how to trade. How do you get started, basically? Will you become a really good trader in 5 days? No. In 50 days? No. Not even in 50 years, okay? Because I'm still learning after 10 years. Still learning the craft here. So what will these 5 days give you is like, it will break your limiting beliefs, if you have any, because I had a lot of them, that I need a big account, I need a lot of money to trade this market, I need all of that. So that's all going to go out of the window. And then I'm going to, every single day, out of 4 out of 5 days, we will set up a live trade setup, live trade example. We will choose different strategies to set up. We will select, we'll go deep into various different strategies. Now, I'm not going to bombard you with too many strategies either. I don't want that, because if I give you too many of the options, then you'll be stuck again, like which one to put on. So the way I trade is like, I only trade 3 or 4 max, and it's taking me years to craft, get better at those. So the idea is to like get you started on at least 1 or 2, keep doing that for years, for months, in your trading account, in your pivot trading account, and then go to the next level, which is undefined risk. I'm going to stick to defined risk strategies here because it's mostly, defined risk stuff that we're doing. But if you get, more engagement from the group that they want to look at the undefined risk strategy as well, we will take a look at that as well. So anyway, there's some takeaways. All of this, the whole enchilada is there. Just take a look at this link and then sign up if you need to. Thank you very much for watching. Bye-bye.